Okay, well, it's almost on expected lines with a hike and no change in the stance. I don't think there was a mild watering down perhaps of the outlook, but nevertheless the Monetary Policy Committee remained focused on calibrated withdrawal of accommodation. They did not see reason to stop the withdrawal of accommodation. The phrase. There have been some changes in terms of inflation forecasts. Now the full year inflation forecast for the current year is 6.5 as opposed to 6.7 earlier. And the fourth quarter inflation forecast has also been brought down to, I think, 5.6. The earlier number was 5.9. Importantly for growth, there has been a revision upward. The 7.1 for the first quarter of next year has been revised up to 7.8. That's a mighty revision. For Q2 of next year, it's been revised up from 5.9 earlier to 6.2. So substantial rise in the first half of next year, giving a total GDP growth of 6.4%. I think this will be one of the most optimistic estimates on the street. The estimates we have got so far are actually straddling 6%, some people at 6.1 and 2, and several people below the 6% mark. But I think the Reserve Bank is making it 6.4 more to align with what the government is expecting in terms of the 10.5% nominal GDP growth. So basically inflation revised a little lower, growth revised rather higher, I must say, for the first half of next year. For the current year, of course, it stays at 4.4 Q3 and 4.2. They are unlikely to change those. But it's the stance and what you're reading from there that we want to know. So let me start with our guests. First up, Kaushik, you were there with us before the policy. So tell us, is it sounding like the last hike at all?
Lata, as I told you, that it will be not an unanimous decision, and there's a 4:2 split. And two people now have said no rate hikes compared to last policy. If you remember, there was only Professor Verma who said no rate hike, and so it was 5:1. So there's been some change, but I think RBI, even if it doesn't want to hike anymore, it can't tell us, and therefore they've kept the room open that if there is a requirement in April, they can do maybe one more rate hike depending on how core inflation behaves, how the Fed is behaving, what happens to the global economy by April. So I think they've kept the room open. But I guess we have done quite a bit, and now from here on, the hurdle for doing a rate hike would be very high, and you have to see things kind of going against, either on inflation or growth in a very big way for RBI to do a further rate hike. I'm surprised with not just the growth forecast, which you alluded to, 6.4, which is higher than the consensus forecast of 6. But if you see inflation forecast of FY24, that's been given at 5.3, where the consensus forecast is about 5%, and April, June, and July, September in most cases is below 5. So I think there's a slight, buffer which RBI has maintained on inflation in case there's a weather-related shock or oil-related shock, which is actually prudent. But this could turn out to be lower, and therefore RBI may not need to do more rate hikes as they go into April.
Yes, sir. It is very important to note that there is no reading of inflation below 5% for all of FY24. They are at 5%, 5.4%, 5.6 it goes to in the fourth quarter. So this is something to ponder about, that the Reserve Bank is looking at an average of 5.3 for next year. It's nowhere near 4%. It is not even below 5%, not even for a single quarter. So that is something to watch out for, and growth also is higher. So if you only looked at the data, there is every reason to believe that the Reserve Bank is not done and may want to keep some space. Upasna, your thoughts?
Yeah, absolutely, Lata. I think firstly, on the GDP numbers, the first quarter is extremely high. We are already lower than market consensus, probably one of the lowest maybe. We had 5.6% for the full year, and the first quarter is at 6.4% for us. So it does provide too much of optimism on the first quarter estimates provided by RBI. On the other side, I think their inflation projections look broadly in sync, apart from the first quarter, which obviously is higher. We are at 4.7%. But they have clearly created buffers for themselves as and when required, as and when data suggests. they would act accordingly. So they've kept the room for incremental hikes open, but nonetheless, I do believe that the need would be limited because there is going to be some downside to the inflation projections unless some other event pans out adversely. So we are looking at a 6.5% for a prolonged period, but I do believe that it will be there for long, 6.5%.
Okay, and your the RBI's GDP is 6.4. What's yours?
5.6%, Lata.
For 6%. Okay, fine.
5.6%.
We have Mr. Setty, the managing director of SBI, with us. Mr. Setty, first up, obviously at 6.5, all the lending rates linked to repo go up. How does it impact SBI at all? Do you think that this keeps the margins intact, or it might peak off the margins? What's your key takeaway on rates?
Yeah, thank you, Lata. Good morning, everyone. I think the floating rate loans, I think we keep saying that we have a very significant book which is actually floating. The external benchmark itself is about 35% of the portfolio is external benchmark linked, I think, which gets repriced immediately. But I think the depositors also will expect some amount of alignment of the interest rates, especially, the inflation still it need to be, brought down. To that extent, I think there will be readjustment in the deposit rates also. But as you said, I think external benchmark linked rates will get repriced immediately. And broadly, I think SBI margins will be protected. We have a significant liquidity in our system. Excess SLR will help us, in terms of providing further credit growth without aggressively increasing the interest rates. I think, broadly speaking, margins, I think, are going to be intact.
Going to be intact, okay. That'll mean, of course, a thumbs up for the entire banking sector, but more for you. I'll come back to you for many questions, Mr. Setty, on the penal charge of loans, the climate regulations, the TReDS expansion, which I think is very important. But let me just get the bond dealers to tell us how yields will move in the market. We have Ashhish and Amandeep with us. Amandeep Chopra, what's your reading of the yields? I think the yields moved up and then they've softened a bit.
Yeah, Lata, I think in terms of the policy announcement, clearly near consensus on the rate hike, no surprises there. But I think on the stance, the market was somewhat divided with some of the participants actually expecting a change of stance in this policy. And I think that's where this disappointment has crept in. But I think the key takeaway clearly is a couple of them. One, the reiteration of core inflation, I think again comes across in the policy statement. Secondly, I think when you look at the change of stance, it's pretty much warranted. RBI has front-loaded its rate hikes. So clearly their growth forecast do factor in the impact of the rate hikes which have been undertaken in 2022. So I guess with the GDP estimates of 6.4, which is barely 40 basis points below what we close the current year with, indicates that maybe they still are somewhat accommodative. And I think they did refer to that when they talked about their liquidity position right now, saying that since the liquidity is surplus and you've seen the average call or even the TREP rates, overnight rates, being about 6.18% does indicate that on the liquidity front they still are somewhat accommodative. Thirdly, I think when you look at the inflation trajectory, it's actually upward sloping. So while we do see a 5.0 print for the Q1, but it goes up to 5.6, and that clearly would not give any comfort to the central bank. So I think from that perspective, they have left the window open, and I think the markets will soon start factoring in a potential rate hike if these numbers were to play out. And I think there is some dispute or maybe some sort of dissent around whether these numbers will really play out over the rest of the year. We'll wait and watch for that. But I think at the present juncture, clearly two things. One, RBI is in no mood to indicate a pause or change of stance. So it does leave a window open for maybe another potential rate hike going forward. And secondly, I guess, they still remain pretty much focused on a much lower inflation target than what I think markets would take comfort from, which is around 5% odd.
Yes. No, I take your point. The governor made it very clear that they're not getting to 4 for the next 1 year. He also referred to core, and he also referred to the difference between inflation. As of March, they are expecting it to be 5.6 for this quarter, and he points out that the repo rate is 6.5. So it is positive real rate in that sense, but it is still lower than what it was before the rate hiking cycle started. So both on liquidity and on rates, he seemed to indicate that RBI is still accommodative, and therefore that should be taken as a hint that you can't rule out a rate hike. Very quickly, Ashhish, what are you reading in terms of, whether there will be a hike and how yields are responding?
Good morning, Lata. So basically, I think a good set of policy from the RBI, and I think let's look at it from a central bank point of view. And there's a lot of asymmetry in, running a policy which is looking at incentivizing growth and managing inflation. Clearly, moving down from a higher interest rate regime, higher inflation regime to a lower one is a far difficult one for the central bank, and their payoffs are actually quite negative for the central bank. So from that sense, I think it's an absolutely right stance. And let's face it, across the world, markets will tend to do whatever they have to, and they will sort of disown what the central banks are saying. But the fact is that, yes, the inflation impulse is still there, while it is softening, but it is not softening a lot. So it's best to wait and watch. And I would rather be with the thought process that will remain higher for longer, and we really have for inflation impulse to settle down. And that is somewhat away. So I think clearly a good set of thought process from the RBI. In fact, it's very comforting to the bond markets, because that will actually make it very stable. My sense on bond yields, I think broadly, I think they should be trending in a range of about 7.25 to 7.35. And simply because we'll have to look at the global headwinds, and given the rate hikes which have happened across the world, you will see some soft patch coming through, and that will make sure that the demand for fixed income is very robust.
Well, Mr. Rajiv Anand, what is your reading? Clearly, RBI has not indicated any pause like the market was expecting. So what happens in terms of your lending rates? Of course, the book that is linked to repo will move up immediately. Will margins remain protected? Deposits expected to, be raised with a lag, Mr. Anand?
I think, as Mr. Setty said, everything that is linked to external benchmark or MCLR will reprice, external benchmark almost immediately, MCLR based on the repricing, etc. And I think it is inevitable that the deposit book will reprice as well. We've already seen non-retail term deposits reprice and reprice quite sharply over the last 6 months or so, and we're already seeing that there is certainly pressure in terms of deposit accretion. While the governor has mentioned that liquidity is accommodative at this point in time, I think you speak to any banker, they will tell you that deposit accretion has been quite anemic at this point in time. And in an environment where the RBI expects growth to be 6.4, which is substantially higher than even our expectations, I think some loosening of that liquidity to be able to support credit growth in that sort of an environment, I think is something that we will need to look at. But in the environment where the way that the RBI has spoken, and I agree with the point that Ashhish just made, it looks like we are going to be higher for longer, not just in India, but I think the articulation from the Fed as well was quite similar. And therefore, in that sort of an environment, to expect liquidity to improve, I think is a bit naive. And so therefore, I do expect that credit growth will continue to be strong. However, one of the things that we will certainly see is, given the fact that corporate demand will continue to be strong, I think corporate spreads will certainly widen from where they are. I mean, today they're about 45, 50 basis points. If you looked at these numbers pre-COVID, they used to be in the vicinity of about 100 basis points. So while the GSEC curve will remain more or less where it is today, I do
Sure.
expect corporate spreads to widen.
All right, you expect corporate spreads to widen. But Mr. Setty, let me come back to you on the penal charges on loans. So the governor has just indicated they will issue draft guidelines on some of the excessive rates to protect customers. What are your expectations on this front, and how will this impact banks like yourself?
I think we'll have to wait for the draft guidelines. But see, broadly, we need to understand the banks and NBFCs charge penal rates on various things. It could be on account of the delayed payments. It could be on account of prepayment of loans. And as Governor mentioned, I think these rates are extremely divergent from one player to another. While most of the public sector banks are very moderate in terms of prepayment charges and the delayed payment charges, I think there are market players who are charged very significant penal rates. And there have been complaints, particularly from the MSME sector, that the prepayment penal charges and the default payment penalty charges are quite high and which require moderation. It may not have a very significant impact on us because, as I said, our penal rates are extremely moderate, and many of the MSMEs, we normally don't charge any prepayment charges. So I think it may not have a very major impact on us. But I think it's very important that some amount of discipline is brought in terms of the penal rate of interest. It's a very welcome move, in my view.
Okay. Yeah, Mr. Setty, just wanted to update on the stock markets as well. You can't call it euphoria. The markets are higher. They were higher before the policy was announced. So it's about 0.5%, 0.46 on the Nifty, and a little less for the Sensex. But the Nifty Bank is trailing a bit. It's in the red, about 0.2%. I don't know if they're taking cues from the fact that with rate hikes, there could be a slowness overall. That possibility is cannot be ruled out. Mr. Setty, I wanted to ask you about the TReDS announcement also. Expansion of the TReDS. Now, I didn't get all the details. Apparently, the factoring companies will be allowed to finance. There will be more rediscounting of the invoices. So, do you think this really eases life for MSMEs?
No, I think TReDS is a wonderful platform in terms of invoice discounting. For various reasons, of course, it has not taken off the way we all have expected. But what I see is that in the last 1-2 years, the TReDS platform has become extremely active. One is the technology has improved. The ease of doing transactions on the TReDS has improved. I think the banks have been very large participants in this TReDS. And if the number of participants, by bringing in the factoring services also into this, definitely widen the market. I didn't really get on the secondary, secondary market for the invoicing. Invoices which are already discounted by a bank, which will improve the liquidity. I think because the volumes are so low, I don't know, will there be any significant secondary market again? So let me just look at what are the real propositions which are coming out. I didn't have enough time to apply on this, but I think any effort to deepen the TReDS market is a very welcome move.
Okay. Yeah, I agree, because the statement, it was a barrage of statements, and a little surprising that the statement is not yet on the website. We normally get it, minutes after the governor finishes speaking, but at the moment it is not yet on the website, so we are not able to, check back with things that we probably heard partially. Rajiv, I just want to ask you, definitely lending rates go up. Do deposit rates go up in step, or do they go up more?
Can I just jump in on the TReDS question, Lata? We are among the largest players
Sure.
on the TReDS platform. InvoiceSmart has a 40% market share.
Yes.
And I agree with the point that Mr. Setty mentioned, that the total volumes that we do on a monthly basis is about 7,000 crores, out of which InvoiceSmart does about 3,000 crores. But in the context of the size of the business, that is potentially possible, I think these numbers are still relatively small. If you look at it on a year-on-year growth, etc., things are doubling, but the overall number still continues to be relatively small, because ultimately, yes, the MSMEs are getting very fine pricing on this platform because of the fact that financiers have to bid for these bills, etc. And I think some of these steps that have been taken today will hopefully begin to widen the base as far as TReDS is concerned. I'm actually not so worried about the fact that there aren't enough financiers, and the fact that the number of financiers has increased will only mean that that MSMEs will get better pricing. For banks, financing on the TReDS platform is beneficial because they get PSL benefits by financing on the TReDS platform. However, I think we need more buyers and more MSMEs onto the TReDS platform to widen it. But I think the measures that have been taken today are certainly beneficial, and we will certainly work to see how we can widen this market. I think to the question that you asked about deposits, like I said, I think non-retail deposits have already moved quite sharply in line with the way that the underlying liquidity and the markets have behaved. We have already seen retail deposits go up as well. So, for example, for a senior citizen rate across most banks has already hit 8%, which I think psychologically is a very, very attractive number for deposits. But I still reiterate, even at these prices, if you look at that overall deposit growth relative to credit growth, still continues to be reasonably anemic, and therefore perhaps we will need to work harder because we're also competing against other products, pension funds, mutual funds, insurance, small savings, etc., to get deposits into household deposits into bank deposits.
Okay, we finally have the statements from the Reserve Bank of India on both the MPC document and the statement on development and policies. Let me just quickly reiterate, as expected, Dr. Ashima Goyal and Professor Jayant Verma have voted against the repo rate hike of 25 basis points. The other 4 MPC members voted in favor of it. And then on the stance as well, you have Dr. Ashima Goyal and Professor Jayant Verma again voting against this part of the resolution. Again, very much on expected line. We were expecting a split vote on both the rate hike and the stance. Plenty there for the customers, for consumers as well, apart from, sort of curbing the penal charges on loans. There's also, extending UPI for inbound travelers when it comes to making merchant payments, starting with, people from G20 countries, and, a QR code-based coin vending machine in 12 cities, which will dispense coins as well. But let me come back to the policy here. And, Kaushik Das, coming back to you. The markets were expecting some sort of a signal from the RBI governor that, perhaps we'll see a pause. And 100% of the respondents to our poll said that February will be the last rate hike. But that seems to be ruled out. What is your reading in terms of actions going ahead, given this higher inflation trajectory that we have now until the end of FY24 at higher than 5%?
Ritu, even if it's the last rate hike, say in the hindsight we get to know this was the last rate hike, RBI cannot tell us that this is the last rate hike. There's a lot of degree of uncertainty which is there, how much the Fed will hike. We got the non-farm payrolls data, which was much higher. So all this repricing is happening as we speak in the global markets as well. So I think the MPC and RBI will like to give them some degree of flexibility so that, when you come to April, you can take a fresh call whether you need to hike or not hike. And for all you know, the consensus expectation that is there that probably this is the last rate hike can happen that in April you may not need to hike anymore, but they don't want to commit that will not hike anymore. And then if you come to a situation where a rate hike is required, then suddenly you might be seen as missing the ball. So that's why RBI has kept that degree of freedom with them. Two things from an economist perspective I would try to kind of bring into the table. One is the impact of transmission lags. If you hike today or if you hike in April, it will take 2-3 quarters for that to impact the real economy variables. So we should remember that in next 2-3 quarters time, growth would be slowing down quite substantially. US probably could be in a recession in the second half. So you should be, thinking about your action today, what impact it can have 2-3 quarters down the line, not just based on what core inflation is today. You should take into consideration what you think about the next 2-3 quarters. The second is how much real interest rate is enough for the Indian economy post-COVID. I think RBI had put up a paper earlier saying that 80 to 100 basis points positive real interest rate is good enough, and that it has come down from 150 to 180 basis points earlier, pre-COVID. Now, if you see, even with RBI's forecast for FY24 inflation at 5.3, and today the policy rate is 650, your positive real interest rate is more than 100 basis points, at least close to 125 basis points. So do you need to hike rates more than that? And the third point, what Lata mentioned, that RBI has not mentioned any number below 5%, and the target is 4. They have indicated 5.3. Remember that the Fed's target is 2% on inflation, but the Fed is expected to stop hiking rates in May or June of this year. And they're not going to see 2% this year. They're probably going to see 2% at best in 2024, but they're stopping much in advance and let the monetary policy autopilot mode come in so that it can have its lagged impact on the real economy. So our thesis is that as growth slows down in the next few quarters, you would see core inflation moving hand in hand and slowing down. Therefore, this probably would be the right time for RBI to pause and assess the amount of rate hikes that they've done, what impact it can have, not just right now, but 3 quarters down the line.
Okay. No, Kaushik, I am not trying to advise the Reserve Bank at all. I'm only looking at signals that they are throwing, and I'm asking y'all whether y'all want to interpret it as hawkish. One of the signs is that there is no number below 5% in terms of forecast. And now that I have the outlook, I have the statement with me, Upasna, I wanted your thoughts on this. To me, the statement actually, seems to exude a lot of worries over inflation. The easing of inflation in the last 2 months was driven by strong deflation in vegetables, which may dissipate with the summer season uptick. Headline inflation, excluding vegetables, has been rising well above the upper tolerance band and may remain elevated, especially with high core inflation pressures. Inflation therefore remains a major risk to the outlook. Domestic economic activity is expected to remain resilient, aided by the sustained focus on capex and infrastructure. But I just wanted to point out that the statements on inflation are, if anything, as cautious or more cautious than what we saw in the previous policy. Plus, there are these forecasts. And then the reference that if you take the 5.6 inflation of this quarter, Jan, Feb, March, and the repo rate at 6.5, there is a difference of 110, but it is less than the difference used to be earlier. The governor is actually saying that. So, are we supposed to read all this as a hint that the likelihood of another rate hike is more than the likelihood of a pause next time, Upasna?
Lata, one thing, even prior to the policy, I was not of the opinion that they're going to anywhere suggest that there would be, this would be the end of the rate hike cycle. It is not possible in this entire uncertain world for any central banker to really come ahead and talk about a possibility of a pause. So that is one thing because of which RBI has to maintain marginally hawkish bias going ahead, not just in this policy, but I think even going into the subsequent policies, we will see that kind of a rhetoric continue, largely because if you look at inflation projections, even if we assume that RBI is little on the higher side of next year's inflation expectations, even then, nowhere are we approaching on a sustainable basis 4% over the next 12 to 15 months. And that is something which we have to keep in mind. That is why there is a need to continue to focus on inflation. That's exactly what RBI has done. And I don't think it's very different from the previous policy. There was a reasonable focus on core inflation that they have retained as of now, that much of the disinflationary pressure that we are seeing is because of food. Otherwise, rest of inflation remains quite sticky and elevated. That is exactly the rhetoric they've maintained. And that's what I was expecting. So for me, I think this policy is very much in line with what we were expecting overall. One thing important is, yes, you referred to the stance, I think, with respect to the real policy rate. And they tried to correlate that or link it with the pre-pandemic real rates that were existing. That's when in one of the previous policies, the governor had mentioned about a 2.3% real policy rate I think about June 2019 or so.
Yes.
That is extremely high, I would say. That is extremely high. I don't think that is where they intend to achieve. But so given all of that, I still believe that they will maintain rhetorics of focus on inflation going ahead as well. But the need for incremental rate hikes will subside because inflation will be moderating going ahead, even though higher than 4%. So keeping all of this in place, 0.5% remains. It will be a close call between April or June for a shift in a stance, I would say.
Okay, fair enough. It still is a divided house. I was just wondering that we probably went into the policy a little more sure that this will be the last. That sense of being absolutely sure seems to be taken off by some of the cautionary statements. Well, we have to wrap up. Let me get two quick ranges from the two bond experts. Amandeep, what's the bond range you think for the quarter?
Lata, I think, we've seen the 10-year yield sort of trade between 735, 740 through most of second half of January. I feel, we could test those ranges again.
Oh, 740. Okay. Ashhish?
Yeah, so there's a distinction there because if you look at a new bond, I would again reiterate, which I already said, 725 to 735 is my range. And important to look and keep looking at the currency. And that's really the key.
Okay. All right. Gentlemen, Mr. Setty, Rajiv, Upasna, Kaushik, Amandeep, Ashhish, thank you very much indeed for giving us your initial reactions on the monetary policy. It looks like largely on expected lines, except that growth is projected a little stronger than we thought, and inflation words, both the quality and the quantity, is slightly higher than what perhaps the market was prepared for. So we have to go with, I think, a slightly more hawkish tone than expected. But the bond yields are, hardly moved a little, 7.34. We wind up our initial discussion of the monetary policy. We have Ashhish Vaidya joining us on the other side of the break to discuss the stock market impact.